Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to discuss some things that I talked about in the Substack last night, and I think it's worth bringing out to the forefront because there's a lot of folks all of a sudden starting to talk about banking crisis and recessions. I've even mentioned the R word in a couple of my posts that I've made on Substack. Let's get into tonight's video. Okay, folks, let's talk about a few things. I am hoping that I can unpack some things that I think are going on. I mentioned in last night's Substack, as I mentioned a minute ago, that we're seeing a lot of folks starting to talk about the banks. And there was an FDIC report that came out recently that was referencing something like 68 banks, 58 billion, might be $68 billion worth of liabilities or the size of the banks. And I tried to make a really good point last night in Substack, is that it would be like owning a 4,600 apartments building and there's 62 of them or 68 of them vacant. It's not material. And even if you just look at a 5-minute operation on the Fed doing repos, it would take nanoseconds to fulfill the entire hole that these banks, if they all went out of business. Now, the fact that they're on this bad bank or watch list, I do air quotes, doesn't really mean that they're in trouble. In fact, what it means is the opposite. The survival rate of most of these banks are in the upper 95%. So when you get on this list, not necessarily a good list to get into, but what it does is it gets the feds and the local state folks watching everything in your portfolio, and while they are going to advise you on what to do, they're actually trying to keep you out of trouble, and they're making sure that asset mismatches are handled appropriately, and so you don't get some small bank just starting to blow up and scare people and you start to get a run on the bank. Now, they don't tell you which of these banks they are when you see these things, but what they do tell you is that the banks exist and what the assets are. They don't want to cause a run going XYZ bank is in trouble or what have you. We've already seen that as like on the Republic situation and Silicon Bank. These were all very big mistakes were made. And I want to bring that back in. Silicon Bank, only reason why they ended up going down was because the state authorities made a big mistake. And I also think there was something going on with the chairman of the board, don't remember his name at the moment, but he was also associated with the board on the local Fed or the San Francisco Fed. I think there was something going on there they didn't want to touch, but the state regulators are the only ones that can actually close the bank, and they did that. Once they did that, it kind of tipped the meter. And those of you that were following me back in those days, I had said at the time that all they needed to do was open up the discount window to fix something. This was very small. Even though it was a big bank in numbers, it was very small in real terms of the overall banking system. Just the current commercial banks, I believe right now, is around 23 or 24 trillion dollars in assets. So for 60 or even 80 billion dollars to go upside down all of a sudden would not be material. And I don't think it would trigger this situation that a lot of folks are talking about. Whenever you're looking at markets that are continue to hover, and we saw a really positive day in the equity markets today, pushing back up towards an all-time high again. But anytime you see this, you always are going to get folks that are talking about some way they want to call the top. There's some effort that's been going on for a very long time, since I've been in the markets over 40 years, that the goal is to call the top or call the bottom. And it's really not a very good business to be in. We've seen people like Harry Dent, Peter Schiff, and those kind of folks talk for decades about this big debacle that's going to happen. And guess what? It never happens. And the reason why it never happens is because there is an awful lot of this monitoring that's going on by the Fed and others. And this is why it's headed off most of the time. Now, in 2008, we had something different going on where we had a bunch of toxic or worthless assets that had been driven into the economy through these terrible lending practices. That's all been cleaned up. Anybody that's tried to get a mortgage knows there's a much different standard. There's no ninja loans or any of those type of things. So coming back to where we are right now, there's a lot of firms that are starting to talk about maybe recession. Like I said, I've actually mentioned this the other night in a headline. I said, are we about to go into a recession? I'm seeing some of this weaknesses as well. But what we've seen many times in these situations is we get this rotation that happens. By rotation, I mean there's some softness in some areas and other areas continue. Now, we saw the job openings the other day downtick, and that was enough to actually trigger the long-term, or we'll call it the 10-year plus yield sector, to drop about 10, 15 basis points almost immediately. All of a sudden, we're back down to the 4.3 level, and everybody's talking about slowing down, and that's been enough to trigger the dialogue in the markets. The thing that always keeps me somewhat sane, and a lot sane, is our database. And I'll just cover that for a minute, because we continue to see that the intermediate database stays well above the 62% level. And when that's happening, there's a material amount of stocks, and these include equities, mutual funds, and stocks that are in a trending mode. And when we're into that type of situation, we tend to have some predictability to the outcome of and the longevity of these trades. Now, I have been running this database that I talk about all the time for nearly about 30 years almost now. It's getting very close to that. And I've been monitoring this step by step. And I know the typical characteristics, but even I have been calling that I think that the intermediate models are going to start to sell, and we haven't seen that just yet. We continue to see short-term models gyrate around and those type of things, but we're not getting the type of real material selling that come into the intermediate database. Some of these trades are getting a little bit long in the tooth, but when we go to the sectors and looking at that from a viewpoint of what the expectations are looking forward is, we're still looking to a minimum of September and beyond as far as that rotation goes. So there's a lot of positives coming into the equity markets as far as that goes. So I will go and suggest that you go ahead and subscribe to the Substack, because I think that's an important way. I spend a lot of time setting up and writing my micro analysis there, and I'm going to go on a little bit more in this video tonight, just talking about general sense as far as what I'm seeing out there and some of the confusion that continues to come in the market. But be very careful, and I've told you folks this before, be very careful when you see these major firms like Morgan or Citi or these banks start to come in with this negative analysis, because they are almost always wrong. I've told you, if you want to be a good investor, just fade these guys. I've trolled Ed Yardini before. I worked at a firm and an institutional rep at the time, and he was our head economist, and virtually almost always wrong, okay? He's gotten a little better in his older age. He's kind of interesting to watch what's going on. Ed's been more right lately in the last couple of years than he was in the past. But regardless of that, what we're really seeing when you see these big banks, big firms, the Morgans and all the big players out there talking about recession and being really negative, I always say there's something else going on. I worked in Merrill Lynch at the research department. I know what goes on behind the scenes. I know the directive that everybody who's an analyst is getting from their department heads, depending on what they're doing, whether you're chip guy or whether you're macro or whatever. There is an agenda that's constantly being played out in these firms, and the agenda always has to do with what's going on with the company inventory and stocks that got to move, keeping people somewhat pushing in the direction that they want them to go. So whenever I see the big firms starting getting negative, this is like bullish, not bearish. These folks make Jim Cramer look good, just so you know. And so pay attention to these things, especially these, I call them the secondary research firms. And even now that Merrill Lynch and Bank of America have been merged for, 12, 14 years almost now, they're not any better than they were when I was at Merrill. Okay, they're the same folks. So let's come back to what I think is going on in the economy right now. And I went through some charts. In fact, what I'll do right now, let's go over and take a look at a couple of the economic charts that I think are worth taking a look at here at the moment. Okay, so what we're seeing here right now is actually the PCE prices. They came under a little bit under control last time we looked at it. But let's take a couple look at some of these other metrics. This is the balance sheet of the Fed, and I want to address this just for a few minutes, because really what we're getting here is the assets have been declining from the standpoint they've been selling off these assets. They're still declining at a pretty good pace, even though I'm going to air quote this, that they said they're slowing down the selling. There still seems to be some selling going on. I'm looking at potentially getting down to about $6.5 trillion, and I've been telling you off and on over the past 6 months or longer that really what's going on with these assets is that they're looking at the balance sheet level that they believe it will take to support what relative risk is in the banking system at this time. And let's face it, that all they have to do, and I've been making this joke since the pandemic back in 2020, for the Fed to print more money, all they have to do is open spreadsheet, add zeros, hit save, close spreadsheet, and instantly there's money there. We saw that when they shut down the economy some in 2020. They just printed, $8 trillion. We need $8 trillion. Okay, click, add the zeros, save. And so that element's always there. So don't be fooled by all of these things that people are talking about, these catastrophic situations. The banking system is obviously very important. So let's look at another metric here. Let's look at M2 money. M2 money is still growing. It's projected to grow up to close to 23 trillion. Right now it's 20 trillion. The algos have been actually very interesting on this because they were forecasting a drop in M2, and now we're seeing a continuation on the upside, and now we're flattening out. And the key element is this chart right here, folks. And this chart is actually the velocity of the money, or how fast it's turning over and basically coming back into the economy. Now it's been going up, which is offsetting some of the growth. This is actually a really good positive situation, but it looks like we're going to pull back in, and there's the probabilities here is that this will probably keep inflation in check if indeed it does come up. If it continues to increase, and that will change that forecast a little bit. So more on that later as we go through this. Another chart of the velocity of the money, if we look at the algos, it's being forecasted that it's going to peak out. And this is why I was focusing on this in Substack and why I'm talking about it now. It does look like at least momentum starting to peak out. And over the next, let's say, Q3, Q4 is where this stuff is likely to come into play. So this general feel here is going to keep fueling market activity, especially in the equities. And we'll have to see what kind of inflation expectations come out as we go through this, as we go through some of these other scenarios here. So here we go. This is the inflation rate. Now, I've been talking about this as well. So some of this is somewhat confusing, and I'm at this point when we start to see metrics that start to argue with the opposite story. So I've been talking about the algos are suggesting that we're going to see an increase in CPI. This happens to be just the general inflation rate year over year, and it does look like there's some potential for this to uptick as we go forward. But what's interesting, and I've talked about this in Substack, and I'll cover this continuing, is that what we're really seeing here from the standpoint of the markets is we're seeing projections for yields to actually come down and as we come into Q3 and 4. And you have to ask, is this a politically motivated situation where we're going to see some sort of lower rates? Maybe the Fed does lower the rates. I still don't think they do it until after the election, but we'll see. I think they're motivated. It looks like the whole world is motivated to do something to stop Trump. And if that's what it takes, maybe they do that. So I'll just say that what being forecasted is that we are going to see the back end of the curve down. We'll cover more of that here shortly. So this is the jobless claims. And so I'm going to go through this whole spectrum, and this is going to give us a bit of a viewpoint of the market. So I haven't given you folks a good rant for a while, so I want to make sure we get through this. But this is basically the jobless claims. They've been steady. I talked about this in Substack a few weeks ago, that literally I think it was 2 or 3 weeks in a row they were exactly the same numbers. Somehow all of these jobless claims came out to the exact same number, and it's almost like the books are being cooked. But what's being forecasted here is that the claims are going to start to climb a little bit. Whether they do or not, this is what we're going to have to watch to see if there is a trend developing. There's actually one of the things that I've wanted to do for a long time, and actually I have the data now with TradingView to be able to forecast some of these using my normal indicators and using a Fibonacci tool. And a Fibonacci tool is suggesting that, we're going to see maybe a 268 number, a little bit higher, nothing drastic, but we're likely to see that. So getting through the rest of these, all the liabilities, deposits with the Federal Reserve banks, and seeing this starting to stabilize, and looks like I don't see any disruptions where anything's going to come in here to play that's going to trigger anything of any sort from the standpoint of squeeze on the banks or things like that. Everything looks pretty normal. So the next chart we'll look at here is the repurchase agreements. And I meant to cover this in Substack the other night and did not get through this. But this is interesting because these are the reverse repurchase agreements. And there was excess capital in the markets. They were removing capital. They still are. Looks like they're trying to get to the point where we've gotten to a liquidity point that they're happy with. And this will be a chart we're going to want to watch as we go through the next quarter or so. And this is right now we're in June, which is the final quarter of Q2, final month of Q2. So we're likely to see these patterns continue to evolve here. The GDP numbers on this screen here now, perpetual move to the upside. The growth just keeps continuing. And I'll just touch on this for a minute, is the key elements I keep talking about, and some folks are maybe tired of hearing it, but the key elements are that my expectation is that AI, especially as we come into 25, 26, is going to start to affect more of the productivity. And this is just forecasting, looking at this, there's a forecast for GDP just to continue to climb. If you go to my Substack, I believe it was the 27th or 29th of December of last year, and you can get through this just by subscribing for free. You can see this report, but it was my outlook for 2024. And one of the things I was talking about there is that we're just going to continue to see this AI boost in as far as the productivity goes, but it really doesn't click in. It's starting to sort of click in at this time, but it doesn't click in until 25 and then 26. And we're also going to see new iterations of GPT and a lot of other players that are coming into this market. We've got this coming out on Friday, non-farm payrolls. And it looks to me like we've got some Fibonacci targets down here. We're looking at the potential for this to continue to decline here. So we're likely to see some of the labor numbers start to fade. And this is what I think a lot of folks are picking up on, but they're throwing it into this really bearish mode. I know I saw a couple podcasts just in the last day or so. They're screaming how negative it is. And this is June 5th, and we had a huge day to the upside in the S&P today. All these indices are very bullish. So the more these folks get bearish, like I said, the more bullish that it is. The final chart that I have here is the housing prices, and they're still forecasting to go higher here. So that's in itself is mind-boggling. And as far as markets are, you keep talking about the real estate downticking, and some of the activity has, but the prices have not yet. So I don't know if it'll be a lag effect or what. But just in closing, I want to point this out, folks, and I appreciate you taking the time to watch this. It's got a little bit longer than I wanted to, but this is the scenario that we're playing out right now, is that we're seeing these softness spots in the economy right now. It doesn't mean that we're going to get into a recessionary period, but it does look like there's some adjustments that are likely to happen. And it's going to be interesting because we've got a Fed meeting coming up next week, and we're going to find out a little more. I totally expect that nothing will change as far as the Fed goes. I think the Fed will actually be more in a pump mode, so things will continue to go on. I wouldn't be surprised at all that we'll see all-time new highs next week, if not before, coming into that meeting. So the expectations are fairly, I guess, high of no change, and that the Fed's not going to do anything. And the key element that we'll watch from a market sentiment standpoint is what's going on with the 10-year securities, to see if we do start to see some of these lower yields. I've talked about just in closing that around 4.25 is the top end of the bond rally, or the bottom end of yields, however you want to look at it. But we should see some stability around that level, and I think that will be it. So I just want to thank everybody that have subscribed and watched this channel. I'm going to continue to do some macro stuff. I've got some educational stuff coming out very soon, and I'm really excited to be back online even at this minimal phase. So have a great day trading, and we'll talk to you real soon. The best of luck as we go forward.